Okay, so let's finish up, and then we're going to go through one other problem in the revenue cycle. So we left off, we were talking about the key steps in our audit approach. And so we tested controls and tested transactions. And so the next step is, remember, under substantive tests, you're going to have substantive tested transactions, substantive test of detailed balances, and substantive analytical procedures. Those are the three types of substantive procedures that you can perform. As I pointed out before last week, substantive tested transactions and tested controls can be performed simultaneously. Right? And so that's why you saw in the previous problem that we just went over what we call dual purpose tests. You can perform an audit procedure and gather information not only about the control, the effectiveness of that control, or that control is operating effectively, but also gather information about the transactions, right? The transaction amount. With analytical procedures at this phase of the audit, in the evidence gathering phase, it is not mandatory. It is not a mandatory step. It is within the auditor's judgment whether or not they use substantive analytical procedures. Most times in most audits they will. The amount of analytical procedures or the extent of substantive analytical procedures they perform is really going to depend again on the audit risk model and their assessment of detection risk. So some of the analytical procedures that are common in the sales and revenue cycle is obviously look at accounts, the sales from one period to the next. Look at changes in accounts receivable. Look at the change in allowance for doubtful accounts. Does it make sense? What is the accounts receivable as a percentage of sales? Accounts receivable as compared to sales. If we see that accounts receivable are rising, but we're seeing that sales are flat or sales are going in the opposite direction, that relationship doesn't make sense. So we'd want to investigate, well, why would that be the case? And obviously you do ratio analysis, days, days sales outstanding, number of days in sales, those types of those types of ratios we would use. In terms of the test of detailed balances, you're trying to get information or gather evidence about accounts such as accounts receivable, the allowance for doubtful accounts. And so what you're concerned with again is then you're going to look at those assertions and design your tests around those assertions related to assertions about account balances, such as existing. So you want to make sure that recorded accounts receivable exists. We went through, in that example, we saw different types of tests you would perform to test the valuation of accounts receivable by looking at allowance for doubtful accounts. So you want to also make sure that accounts receivable is complete. Existing accounts receivable, all accounts receivable that should be included have been included in the account, that it's accurate, that it's properly classified, that you're not reflecting, let's say, intercompany sales or related party receivables in accounts receivable. This accounts receivable should only reflect trade receivables. That the cutoff is appropriate. Right? So again, this is something that you would look at in conjunction with your testing of cutoff related to sales. That they're stated at its net realizable value. That's your testing of the allowance for doubtful accounts. You want to make sure that accounts receivable hasn't been factored. Right? That the company didn't sell accounts receivable. Again, what you're concerned about, they have the rights to those accounts receivable. That is accurately presented and disclosed. Right? So presented, right? We know how we present accounts receivable. It's a current asset, and it should be presented net of allowance for doubtful accounts, right? And then there are usually disclosures about accounts receivable in the footnotes to the financial statements. So those are, so accounts receivable would be, and allowance for doubtful accounts would be the two primary balance sheet accounts that you would look at related to sales and collection. As I pointed out, some of the substantive procedures analytical procedures that we would normally look at related to accounts receivable or the sales and collection cycle would be turnover and days outstanding. So these are some basic ratios that you've probably already covered in your financial accounting class. Another thing you would do is look at the aging categories, because you have to test the allowance for doubtful accounts and have some information about whether or not the allowance for doubtful accounts is accurate, right? You want to gather evidence that the company, because you're gathering evidence about management's rationale for developing their estimate of the allowance for doubtful accounts, because that is just it. It's management's judgment, right? Because at this point, you haven't written anything off, right? So you want to understand, gather evidence about, to be able to test management's rationale for developing their estimate related to the allowance for doubtful accounts. Bad debts as a percentage of revenue, right? Another things would be allowance for uncollectible accounts as a percentage of the accounts receivable or credit sales, any large account balances compared to last period. So here you'd look to see if there are any outliers, right? Because your customers are usually going to have the same volume of business over time. So that's that. So if you're seeing that there are a large accounts receivable balance outstanding as compared to prior periods, then that should raise a red flag, and you're going to want to investigate that. The biggest substantive test of detail for accounts receivable is confirmations. Confirmations are required for accounts receivable. The auditor that is the best source of evidence, but it's also a problematic source of evidence. And the reason it's a problematic source of evidence is because customers don't always respond, right? Or they'll respond with information that does not pertain to the reporting period. They might respond with issues about, a sale that was made or shipment. But a lot of times they don't respond. And so auditors have to continuously follow up. But a confirmation process is basically obtaining information or evidence from the third party. In this case, it would be the customer. And as I said, the auditor is required to confirm. The auditing standards say that. When we talk about cash, we'll talk about confirmations again. But accounts receivable, as I said, have to be confirmed unless the auditor deems accounts receivable to be immaterial to the company's financial statements. If they've concluded that evidence about confirmations will provide ineffective evidence. Yes, Ricardo.
That's the reason why most company accounting firms are doing just the negative confirm,
But that's not, I wouldn't feel comfortable with that, right? Because and here's why. Right, I know. But I would believe if they're doing negative confirmations, they have evidence that would suggest that accounts receivables are fairly presented, that there are no material misstatements. They've gotten other evidence to support the accounts receivable balance. Because with accounts receivable, it's not unusual for customers not to reply. So by getting a negative confirmation, by not getting a reply doesn't tell you anything, right? Because it's kind of common practice that customers don't reply, right? So, and we'll talk in a minute about alternative procedures that they could perform. Usually you're going to see, and they might send out negative confirmations for smaller balances, but for larger balances, they're performing other alternative procedures. So, but again, if the auditor thinks that the evidence that they would gather from confirmations would not be sufficient and appropriate evidence, then and you have to document your rationale for that, then they don't have to perform it. And then finally, if it's the combined level of inherent risk and control risk is low, and other substantive evidence can be accumulated to provide sufficient evidence, then they don't have to confirm. And that's what I think those would be that would be a scenario where they might send out negative confirmations for smaller balances because it's very low inherent risk and control risk. But I want you to key in on then other substantive evidence, right? So it's not enough to say internal control risk is low, inherent risk is low, so therefore I'm confident that accounts receivable doesn't contain any material misstatement. The auditors have to perform alternative substantive evidence. They have to obtain other substantive evidence to support that balance. Okay. There are different types of confirmations. Positive confirmations are basically a confirmation you send to the customer. The records show XYZ, confirm that amount, and the customer will confirm that amount. Blank confirmation is exactly as it says. You send it to the customer and let them fill it in. You can confirm on an invoice by invoice basis as opposed to just confirming the account balance. And you might see this type of confirmation with contractors or companies that have building. So you have these large work orders, so you might confirm only the large invoice balances on an invoice by invoice basis versus the total balance. And then negative confirmations where you send it out and you say basically if you agree, basically don't send it back. Right. So you want to send the confirmations as close as possible to the balance sheet date. So you really wouldn't want to send confirmations before year end. Normally confirmations will go out after year end, right? Because there could be activity that takes place, and then you would have, if you did send it out before year end, you would have to reconcile that balance for the date that you received the confirmation to the activity that occurred after you sent out the confirmation through year end. Right? So usually you'll see confirmations go out during the year end audit process. Now, the standards also say that it's not enough to say that I sent out a confirmation and the customer didn't respond, right? And I'm going to take that as a positive, that because they didn't respond, this balance is correct, right? You have to perform follow-up procedures. SAS 67, when positive confirmations are used, you have to follow-up procedures to ensure, for those confirmations that have not been returned by the customer, to gather evidence about the amount recorded. Right? And so those follow-up procedures usually entail subsequent cash receipts, and that's probably the best alternative procedure. And because you're there after year end and you're confirming as of year end, you're probably going to see cash collections on that account. Right? You're probably going to see, because most companies will have a 30-day window for customers to pay them, and so by the time you come in to do the audit, you've probably seen, you can see that the subsequent cash receipts have been received on those balances. So that's probably the best, because obviously if I didn't owe you any money, why would I pay you? Right? The customer's not going to pay just because. You could also look at duplicate sales invoices to verify the actual issuance of a sales invoice and a billing date. And again, keep in mind that when you're doing this, the auditor to be able to rely on this, duplicate sales invoices, they would have to have tested controls over the sales transaction process, as well as gather information about the amounts recorded in the sales journal. So they would have, in other words, have to satisfy, at this point, would have to have satisfied assertions related to sales and transactions and events related to sales, right? And another way, obviously, that I think is probably more accurate than duplicate sales invoices is shipping documents. Right? So all that really tells you, though, at this point, is that tells you that it's a valid accounts receivable, right? If I shipped it, I did process a sale for this customer, and so there's a corresponding receivable. But probably the most used alternative procedure would be first to look at subsequent cash collections, and then if there's not been a cash receipt associated with that receivable, then to look at either shipping documents or duplicate sales invoices. So we did that problem already. Do that one. Okay. So we've kind of laid out the 6 steps in gathering evidence about the sales and collection cycle. And so now at this point, right, you've gone through the audit of that business process. Now you want to evaluate your audit findings, right? So you're going to look at You've completed the plan substantive procedures. Now you want to look at, are there any potential misstatements? Are there any misstatements? And then you have to project those misstatements, because remember, you're trying to gather evidence about the risk of a material misstatement, right? Is there a material misstatement? And we'll talk more about this, the sampling risk, when we talk about cover sampling. But you have to look at, remember, you're taking a sample. You're not looking at items 100%. You're taking a sample of items. And from that sample, you're going to project what, if you find errors in your sample, for example, you have to now project those errors to the entire population. So for example, if you looked at 500 transactions out of 1,000, right? And you found, in your 500, you found 10% error, errors amounting to about 10% of the sample size. You have to project that. You can't just show those errors as your misstatements, your likely misstatements. You have to project that 10% to the entire population. So you have to project that 10% to the 1,000 transactions that occurred. That's your likely misstatement. And the reason it's likely is because you don't know with certainty that that's a misstatement. You're only basing that on your samples testing, the results of your sampling. Then you also have known misstatements. And those are the misstatements that you can identify, right, without any estimate. So for example, if you are confirming accounts receivable, and the client you confirm with the customer, the client had the customer's accounts receivable as being $500,000, but when you got the customer confirmation back, the customer said, oh no, we only owe $400,000 because we returned those goods before year end, right? We returned those goods on 12/30/2013. So we only owe them $400,000. And you go in, but the client still has $500,000 posted. The difference between the 4 and the 5, the $100,000, that's a misstatement, right? That account is misstated by $100,000. So that's what I mean by a known misstatement versus sampling gives you a likely misstatement. Another example of a likely misstatement is if you find a difference in what the client has recorded for the allowance for doubtful accounts and what the auditor calculates the allowance for doubtful accounts to be. The reason to that's a likely misstatement is because, again, allowance for doubtful accounts is an estimate. It's your best estimate given the evidence that you have. If you and the client, if the auditor and the client has a difference of opinion and the client agrees with the auditor, okay, yeah, we should probably increase the allowance for doubtful accounts by, let's say, $50,000, that is a likely misstatement in allowance for doubtful accounts, right? You see the difference between known errors and likely errors, right? Mostly likely errors are coming from estimates and from sampling, right? So the auditor has to consider those errors in total and look at those and say, what is my misstatement? So is your likely misstatement, if your misstatements are less than your tolerable materiality limit for that account, right? If it's less than a tolerable materiality limit level that the auditor set back in the planning stage, then you can conclude that the account is fairly stated. Why? Because it's not material. The differences are not considered material. They're less than a tolerable misstatement, right? I'm sorry, less than a tolerable materiality level that the auditor is willing to accept. If it's greater than that number, right? So if it's greater than tolerable materiality, then the auditor is going to conclude that the account is not fairly presented. So what do you think happens if the auditor concludes that the account is not fairly presented? Do they give the client a qualified opinion? Adverse opinion? What? And what do they do? Couldn't they still give them an unqualified opinion?
They could state that it wasn't fairly presented, or it depended on the institution
then that would be a qualified opinion or an adverse opinion. Right, they suggest, right? They propose a change, right? Because if you've done the audit, you found the errors, so what you would propose is you would make a propose an adjustment that the client would book. And by booking that adjustment, then the accounts are no longer misstated, right? Right, so if the accounts, now, and it's the client's books and records, the auditor can only propose the adjustment. What do you think happens if the auditor proposes the adjustment and the client says, I'm not booking that, I don't think you're right? Right, they can issue a qualified or an adverse opinion. But who is the auditor? Well, that would be a big step, right? But of course, they can resign from the client. They can resign because they could say, we're not going to issue an audit opinion. We're not going to issue you a clean audit opinion. We're going to issue an adverse opinion. And the client might fight them. But who does the auditor report to? No, the audit firm. Who does the audit firm report? The audit committee, right? So they report to the audit committee for that client, right? Just for that client. They report to the audit committee. The audit committee hires the auditor. So the client, if the auditor and the client found themselves in a situation where the auditor was proposing an adjustment, and this is big, it obviously has to be material, and the auditor feels very strongly about, if you don't book this adjustment, then there's no way we can issue a clean opinion on this. Before they take the step of issuing an adverse opinion or a qualified opinion, they're going to talk to the audit committee. That's the audit committee's role, right? The audit committee has oversight over the financial reporting process and the auditing process as it pertains to that company. So it's the auditor has a responsibility to report these types of things to the audit committee, especially if they're unable to resolve these issues with clients. There's this, in the standard, and I'm sorry I can't remember the number off the top of my head, but in the standard, there's a standard that basically says, that deals with communication, the auditor's responsibilities for communications with the audit committee, and it talks about these types of things. Okay, so before they got to that point, they would obviously bring these types of issues to the audit committee. And but if the client, ultimately management is responsible for issuing the financial statements. And so if the auditor feels as though management and the audit committee, because the audit committee doesn't have to side with the auditor, right? And if they feel that the client is not willing to book it, they can issue an adverse opinion, or they can withdraw from the audit engagement. All right, any questions about what we covered before we work on another problem? Any questions about the sales and collection process? Any questions about the audit process related?
Can we go over the review collectability?
Say that.
Review collectability.
When you say collectability, what do you mean?
Here states that the customer compares the account. It doesn't mean that the customer will pay or anything. So.
Right. Okay, I'm sorry. I see. So So the only thing that a confirmation tells you is that accounts receivable exists as of 12/31/2013, as of year end. That's the only thing that the confirmation tells you. But because GAAP says that accounts receivable has to be recorded at its net realizable value, you also have to look at the collectability of receivables. And that's your review of the allowance for doubtful accounts, right? So you're going to look at how likely is it that they're going to collect on it. Because you can have a receivable, let's say, that's been outstanding for 90 days. The auditor would probably still confirm that accounts receivable. It's been outstanding for 90 days because that satisfies existence, right? That says that, yeah, it exists. The customer might not confirm it at all because, hey, they haven't paid in 90 days. They're not going to, send you a confirmation saying, yeah, I owe you money. right? So you don't know at that point the collectability of that accounts receivable, especially because since that accounts receivable has been outstanding for 90 days. That is how your review of the allowance for doubtful accounts and the client's aging, how they're aging the allowance and the percentages that they're assigning, right? You look at those types of things to determine the collectability, how likely it is that the client is going to collect on that receivable, and you look at the client's history in collecting, let's say, on receivables that have been outstanding greater than 90 days or greater than 120 days. And that's the important, that's why you can't only look at accounts receivable, you have to look at allowance for doubtful accounts to determine the net realizable value of accounts receivable. Does that make sense?